The 4% rule is probably one of the most well-known retirement distribution strategies that people reference and cite in different literature and articles, but almost always people are citing it incorrectly and talking about it wrong. So in this video, we're going to reset the narrative and talk about exactly what the 4% rule is, what it was intended to be, some of its pitfalls and limitations, and some things you should be aware of if you're going to actually try to implement William Bengen's 1994 paper on the 4% rule. It is a distribution strategy for retirement. So it's all about, I've got a bunch of money, I've retired, congratulations, and I want to make sure that my wealth outlives me. So what do I do? William Bengen was a financial planner, and in 1994, he did a study where he went back to 1927 or 1925, something like that, and he did some tests to see what would be a safe distribution rate, adjusting for inflation, to make sure that I could have a retirement that would outlive my lifetime in roughly 30 years. So if you start then, taking out 4% per year adjusted for inflation, do I run out of money during that any time in that period? He did that for 5%, 5.5%. So for different withdrawal rates, he would go through and pretend like you had this 5% inflation adjusted distribution rate for a 30-year period starting in 1927. He collected all of these real life examples of people who retired and took money out of their portfolio for the remainder of their life and adjusted it for inflation. And he found that if you were to use a 4% withdrawal rate adjusted for inflation, that you would never run out of money. Now, this is where it gets a little bit maybe miscited, because the premise of the 4% rule was 4% adjusted for inflation. And I will routinely hear people refer to the 4% rule as, well, my portfolio value last year was $1 million, so I took out $40,000. The next year it might be 1.5 million, let's say, and they're going to take out $60,000. And that's actually not what the 4% rule says. The main premise of the 4% rule is that when you start taking your distributions, those distributions, you will continue to take them and adjust them for inflation for the rest of your life, regardless of what goes on in the market. So if your $1 million went to a 1.5 million, you would continue to take $40,000 adjusted for inflation for that year. If it went to $500,000, you would take $40,000 adjusted for the inflation rate for that year. So what that means is that every single year you take out successively a little bit more money to accommodate inflation and maintain your standard of living, regardless of what goes on with the value of your account. And his results show that you go through the Great Depression, you go through stagflation, you go through all of these time periods, and a 4% withdrawal rate adjusted for inflation allows you to have your wealth outlive you. So that's the main critique that I hear, is people will say 4% and they think it's the year-end value, which that actually is not the case. It's 4% every year adjusted for inflation. Obviously, if you want to take out less money, you're more than welcome to do, and that would just improve the potential likelihood. You could also take out more, and that just impacts the plan more negatively. But the 4% rule, the way it was intended, was whatever number you start with to distribute. So in this case, if you had $1 million, you took out $40,000, which is 4%. You would always take that $40,000 and each year adjust it for inflation. So this worked during a time period when we had a lot of volatility in the stock market, which we're fairly comfortable with. We also have had a period where we've had some declining rates in recent years, and bond yields were also higher. So there's some reasons, market reasons, maybe economic reasons, why we've seen this strategy work. And it also just happens to be that it's a really small sample when you're thinking about it statistically, to have a 100-year period where you're looking at different chunks of 40-year periods within it. It's a very small subsample of, we'll say, the investing history, which goes back millennia. So this example, it's a really small snapshot of time, but it's a great rule of thumb to get started with. How do I think about distributing my assets? Some of the things that make it a great way to distribute your assets is that it's really simple and easy to understand. So most everybody can think, I need to take money out in retirement. How much should I take? 4% is a great place to start. How you go about executing that exactly is a little bit more nuanced, because as you can see, people have tripped up on the 4% thinking it's a year-end balance, when really it's actually the inflation-adjusted starting amount. So it's a little tricky. People do run into that, but that's okay, and that's one of the things that we're here to help with. So where we have some limitations you might see today is that if we start to look at this we have a lot more data and ability to simulate different market environments, but what we'll see is one, bond yields are substantially lower. If you remember getting a mortgage for 9 or 10% back in the 80s, then you also know that treasury yields were substantially higher than where they are today. And the Fed only continues to say they would like to see them go lower. May or may not materialize, but that is what the Fed says. So we know that interest rates have been lower over the last decade than what they've been historically. People are living longer, so 30 years might not be enough. The 40-year studies done in the paper, sure, maybe it is enough. But again, the sample size that we're looking at is 100 years, and in the grand scheme of investing, which goes from millennia, we're talking pre-Christ here, that's a long time and a lot of investment outcomes that are not being accounted for within the 1900s when this paper was written. We also don't really know exactly how market volatility is going to play a role in future outcomes. So a lot of this came through, we had World War I, World War II, and so the United States was really a powerhouse in rebuilding the world during most of this study. So there was a lot of wealth that was focused and concentrated on domestic U.S. investors, and that may not necessarily play out in the future. So it could, certainly nothing to say that it can't happen, but it just means the future might look different than the past. And we just need to be aware of that and be able to accommodate it when we're thinking about how much money should you take out in retirement on a year-to-year basis. We've seen that there are people that will come out with different suggestions. Morningstar usually comes out with their estimate every year of what a safe withdrawal rate is. So sometimes people will say it's 3.5%. Sometimes they'll say it's 5 or 5.5%. And really it's just dependent on the market environment, and it's also dependent on your life expectancy for sure, but it's dependent on what's going on in the economy in the world, whether or not it's likely to be able to realize the distribution rate that you need. And so 4% is a great place to start from. The 4% rule is not the only way to distribute money in retirement. Like I said, it's a great rule of thumb and a place to start from, but what makes a lot of sense for a lot of people is to think about it, when you think about retirement planning in a broad context, you can start to think about it like, okay, I could take out dynamic withdrawals based on what I need or what goals I might have for a year. You might think about it like, hey, when I'm younger, I'm probably going to want to spend more money than when I'm older. So what can we do to try to front load some of those distributions so that way I can have fun when I want to? Because you might want to take the skiing trip to the Alps now when you're in your 60s or 50s, 60s, or even early 70s. But when you're 85 years old, you're probably going to break an ankle. So it might not be the time to go do it. You can also look at things like annuities are also a way that people will use to create an income stream. Those are typically level, meaning they don't adjust for inflation, which is also a downside. But really there's 3 ways that people do it. One, they'll dynamically adjust their spending based on what is going on in their accounts, which might be hard for some people. If the market's up, you'll be able to spend more. If market's down, maybe you spend less. So dynamic withdrawals, again, that's one way that people manage it. Another way is to bucket it based on where they are in life and what they're looking to accomplish today and what they want to do because of their age. And the last one would be annuities. The main thing is that when you think about the 4% rule, you have to disaggregate the distribution you're taking from your money with the money itself. Because once you retire and you say, I'm going to use the 4% rule, then you basically take your investment portfolio and you put it off to the side, take 4% of that amount, and that amount you just every single year, you adjust it upward or downward for inflation or deflation, and you do that for the rest of your life. So that is the main mindset shift that when I talk with people that people need to make when it comes to dealing with the 4% rule, is separating the distribution amount from the investment portfolio. There's some research to suggest that it works and it has a high probability of success, but it's, again, investing has risks and there's no guarantees or promises that you're going to have your wealth outlive you. The biggest risk is the future is not going to look like the past, but it might rhyme. So it's a great rule of thumb, but not necessarily, it's not fact, it's not gravity. And then the other thing is going to be, think about the goals that you have. If you inflation adjust the same amount for the rest of your life, yes, you might be able to maintain the same standard of living when you're 90 as when you're 60, but the reality is most people probably are more active in trying to accomplish more things when they're 60, 65, 70 than when they're 85, 90, or 95. And so those are some things to think about and try and plan for as you're putting together a holistic view of how do I want to spend my retirement dollars for the next 30 or 40 years. So as we've gone through this, what you'll notice is that the 4% rule, because it's a great rule of thumb, it's a nice place to start, but it's not perfect for everybody. So if you're looking for help, if you're interested in what is my actual number, what makes sense for me now in my stage of life and with my goals, that's where you can reach out, let us know what questions you have, and we're happy to answer them. You can also download the retirement readiness checklist. And lastly, if you like this, please subscribe, follow us along here so you can get more helpful tips.